How does a massive land acquisition near a bustling airport impact the commercial real estate landscape? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant development in the commercial real estate sector, Holley Development Company, a Texas-based firm, has acquired 422 acres of land near McKinney National Airport. This property is strategically located at 1245 County Road 722 in McKinney, directly north of the city's expanding commercial terminal. The land also features frontage along the Texas Department of Transportation's Spur 399 expansion and is contiguous with a 39-acre tract that Holley Development Company purchased in the fall of 2024. This acquisition is expected to have a substantial impact on the area's commercial real estate dynamics, particularly given the proximity to the airport. The expansion of McKinney National Airport and surrounding developments could drive significant interest from various sectors, including industrial and retail. While this development unfolds in Texas, it's worth considering the parallels in Canadian markets, such as the Kitchener-Waterloo region, where proximity to airports and major transport links similarly influences commercial real estate activities. In both regions, such strategic acquisitions are likely to attract businesses seeking logistical advantages. In Sanford, North Carolina, the retail phase of a major mixed-use project is beginning to take shape, according to reports from the Triangle Business Journal. This development is part of a larger effort to create a live work-play environment in one of North Carolina's rapidly growing small cities. The project is set to include not only retail spaces, but also residential units and office spaces, aiming to attract a diverse range of tenants and residents. This development reflects a broader trend in commercial real estate, where mixed-use projects are becoming increasingly popular. These projects offer a blend of residential, commercial, and sometimes industrial spaces, providing a comprehensive environment that meets the needs of modern urban living. Looking north to Canada, cities like Kitchener-Waterloo are also seeing similar developments. The emphasis on mixed-use spaces in these Canadian markets is driven by the need for efficient land use and the desire to create vibrant communities that integrate living, working, and leisure activities in one area. In the United States, the Raleigh-Durham area is a prime example of how these mixed-use developments are evolving. Developers are focusing on creating destination spaces that attract both businesses and residents, contributing to the region's reputation as a dynamic hub for growth and innovation. In a major transaction in the industrial real estate market, Town Lane, a real estate investment management firm, has announced the acquisition of a 2.7 million square foot infill portfolio of shallow bay industrial real estate in the Raleigh-Durham area. This portfolio, purchased from Corebridge Real Estate Investors and Equus Capital Partners, encompasses 55 buildings across 6 industrial parks and includes nearly 40 acres of land available for future development. This acquisition highlights the growing demand for last-mile industrial spaces that are crucial for efficient supply chains and local distribution. The Raleigh-Durham market continues to be one of the most dynamic and high-growth regions in the United States, benefiting from a rapidly growing population, a highly educated workforce, and significant business investments across various sectors, such as technology, manufacturing, and healthcare. These factors contribute to the region's attractiveness for industrial real estate investments, making it a prime target for firms like Town Lane, which seeks to capitalize on these growth trends. In comparison, the Kitchener-Waterloo region in Ontario, Canada, also demonstrates significant potential for industrial real estate development, driven by similar factors such as a strong tech sector presence and a strategic location within the Greater Toronto Area. The demand for industrial spaces in Kitchener-Waterloo is fueled by the need for efficient logistics and distribution networks, paralleling the trends observed in Raleigh-Durham. This acquisition by Town Lane is indicative of a broader strategy to invest in high-quality, infill industrial real estate in growth markets that offer enduring fundamentals. The portfolio's location in supply-constrained areas ensures its resilience across economic cycles, serving a diverse mix of regional and local economy tenants. The property's strategic infill locations and varying suite sizes make them attractive to a wide range of businesses, maintaining high occupancy rates and stable returns. Town Lane plans to further enhance the portfolio by continuing to invest in value-add capital expenditures, aiming to improve the infrastructure and meet the evolving needs of its tenants. The firm is poised to leverage its newly acquired assets to support the region's economic growth and cater to the increasing demand for industrial real estate in Raleigh-Durham, setting a precedent for similar markets, including those in Canada. In a notable transaction within the hotel industry, Hyatt Hotels Corporation has reached an agreement to sell a portfolio of 15 resorts for a total of $2 billion. This sale aligns with Hyatt's strategic focus on expanding its all-inclusive offerings while simultaneously reducing its real estate holdings. The buyer, Tortuga Resorts, is a joint venture between KSL Capital Partners and Rodina, as reported by Bloomberg's Patrick Clark. The transaction is anticipated to be finalized by the end of the year. Moreover, Hyatt has the potential to earn an additional $143 million contingent upon meeting specific operating thresholds. This sale stems from Hyatt's recent acquisition of Playa Hotels and Resorts NV, which was completed earlier this month, and includes resorts located in the Dominican Republic, Jamaica, and Mexico. Notably, Hyatt will retain long-term management contracts for 13 out of the 15 hotels, lasting up to 50 years. This arrangement allows Hyatt to continue earning management fees and leverage these properties to enhance the value of its loyalty program. As a result, Hyatt effectively pays a net purchase price of approximately $555 million for Playa's management business. Under the leadership of Chief Executive Officer Mark Hoplamazian, Hyatt has been actively pursuing growth in the all-inclusive resort sector. This includes the acquisition of Apple Leisure Group and forming a joint venture with Grupo Pinheiro, further solidifying its position in the market. In a recent report from BOMA International, President and Chief Operating Officer Mary Lou Peck highlighted a critical challenge facing the commercial real estate industry today: attracting, developing, and retaining the workforce. Speaking at BOMA International's conference and exposition in Boston, Peck emphasized that the industry's approach to talent needs to evolve beyond traditional principles. She warned that without adapting, commercial real estate may struggle to fill all its workforce needs. Peck pointed out that the business culture often reflects qualities associated with the silent generation, which may not resonate with the newer generations entering the workforce. Peck noted that baby boomers, despite stereotypes, have driven economic growth and innovation. Similarly, Generation X has contributed significantly to the digital revolution and work-life balance. As for Generation Z, Peck argued that they are often misunderstood. While some label them as hypersensitive or lacking in soft skills, Peck asserted that Gen Z is actually hardworking, tech-savvy, and deeply concerned about societal issues. However, they require a management style that aligns with their expectations, such as managing to outcomes rather than traditional office time. Peck emphasized the importance of mentoring Gen Z and providing daily feedback. She noted that this generation views job hopping as a strategic career move and wants to collaborate with employers to build the future. Without a new approach to talent management, Peck warns that the commercial real estate industry will face significant workforce shortages. In terms of market resilience, Peck reported that the commercial real estate industry has shown strength despite tight capital markets and trade uncertainties. Industrial and multifamily markets have been leading the way, with an 11.3% increase in deal volume year over year in the first quarter. This indicates a positive trend, albeit with some delays in financing decisions. Peck also highlighted that 44% of foreign investors plan to increase their investment in United States real estate this year, signaling confidence in the market despite ongoing trade issues. The industrial sector in particular is undergoing a transformation towards data centers and manufacturing, with 346 million square feet of industrial facilities currently under construction. Office vacancy rates, however, remain a concern at about 20%, yet the sector is at the cusp of a long-term transformation. Nearly 55 million square feet of new office space are under construction, reflecting a shift in how office spaces are being utilized and developed. This BOMA report underscores the need for the commercial real estate industry to adapt to changing workforce dynamics and market conditions to continue thriving. It's clear that embracing new talent management strategies and market trends is crucial for sustained growth. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.